Good afternoon, everybody. Welcome to today's webinar presented by Libro Credit Union, Principal Tax Sheltered Savings, leveraging the best saving options for RRSPs, TFSAs, and FHSAs, or registered retirement savings plans, tax-free savings accounts, and first home savings accounts. We'll try to keep the acronyms to a minimum today as best we can. My name is Paul McQueen. I am the VP of Wealth here at Libro, and on behalf of all of my 800 plus colleagues at Libro, want to welcome you to today's webinar. I'll introduce our guest speaker, Doug Carroll, momentarily. First, just a little bit about Libro and our team here. Again, 36 locations across southwestern Ontario, serving over, I believe it's actually over 110,000 owners today, but we'll go with 108 on the slide. We are a B Corp certified organization, which means we are not just interested in the pursuit of profit, but looking at some sort of purpose for that profit. And that certainly is reflected in these kinds of educational seminars and hopefully the work we do with our owners and our communities every day. A couple housekeeping items for today's call. It is a little bit one directional. So if you do have questions, please use the Q&A or the Q&A function in the invite here today. Please, general questions generally work best. If there's something that's really specific to you and your personal situation, we'll still do our best to answer it, but we might not be able to answer it very personally, and we'd refer that to one of our local coaches for additional assistance. But if you do have questions about anything we talk about today, please feel free to put them into the chat and we'll do our best to answer as many of them as possible. There will be a recording and handout available after the call. So if you are taking notes and you missed something, don't worry about it. There will be some follow-up information that we'll share as well as a replay of the presentation today. All of that, it does give me pleasure to introduce our guest speaker today, Doug Carroll. Doug Carroll is the tax and estate specialist for Aviso Wealth. Aviso Wealth is our wealth management partner, as well as most of the credit unions across Canada. Doug previously ran an estate planning law practice and was an advanced case consultant with a life insurer and a mutual fund company. Doug holds a business degree and a master's of law, specializing in tax, and is qualified as a certified financial planner professional. He's been doing this for over 25 years, supporting our financial advisors and financial advisors across the country, from written articles to individual case consultations and webinars such as the one that we're hosting today. So with all that aside, my pleasure to turn the presentation over at this point to Doug Carroll. Doug.
Okay. Thank you very much, Paul. I'm hoping that you can hear me, number one. And I'm going to shoot up my slides so that I can show you what it is that I'm going to get into here. I appreciate that you've given everybody the heads up that that the content that we've got here does have handouts associated with it, and that you gave the acronyms at the start. I will try not to do a ton more. They're already in there, so if they show up on the screen, then I'll make a point of filling them out. But generally, it's pretty plain language as I'm going through the content that I'm showing you here. So the topic that we've got, we will get into, just at the end, we'll get into the first home savings account now that it's come into being as of this year. And the TFSA and the RRSP is the main comparison that I'll take you through, because those have, they really do have a kind of flip side kind of relationship between the two. They're not fully mirrored in all respects, but they do very much have either side of their tax treatment looking like the other one on the other end of things. And hopefully you'll understand what it is that I'm talking about as I take you through this in just a few minutes. So the topics that I'm going to take you through, I've got 10 topics here. I've checked it, and sometimes I have an extra slide, as I quite often will say for those of you who've joined other sessions that we've done. But it's just the 10 topics here. The one extra, mind you, is a little bit on the first home savings account. So that will be towards the end of the material that I've got showing here. And I'm going to start with just talking about RRSPs. I think that most people would have a pretty good familiarity with RRSPs. If you're a saver already, if you've been working, they've been around pretty much for the entire lives of all of us who are on here since they were introduced back in 1957. And the TFSA was introduced much later, about a decade, not quite a decade and a half ago. So I'll talk about the RSP first as the groundwork, so that in part I can play off of the RSP concepts in talking about the tax-free savings account, which again would probably be quite familiar to people, but it not necessarily is something that you've gone deep into. And we're not going to go do any heavy-duty arithmetic here. I will touch on some of that, but I'm not going to make you get out your slide rules or your calculators in order to figure things out. I have a couple of calculations to show you what they are, and you can always look back at it from the material that we share with you subsequent to look it over a little bit more closely if you wish. Again, it's not a test that we're going to put you through here. So look at the two of those, TFSA, RSP, and compare the two. Give you some numbers to reconfirm things towards the end, and then compare which one is appropriate for which purposes. And then a final thought, not showing on the screen here, but the final thought on the first home savings account and how it connects up with these, and how all three of the programs might be used in order to accumulate the money for the down payment on a new home. So starting here with just the basic notion of savings, you will hear, or you may very well say, that you might prefer to save one way or the other, TFSA or RSP. And of course, that's not the only place where people can place their money. You can spend your money outright. You can save in other places that are not TFSAs and RSPs. But in looking at the two, the first point that I'd like to emphasize is, when you are living your life and spending the money to take care of yourself, you want to make sure that you are also taking care of your future self. And so having a commitment to saving, in a way, having had a good discussion with your coach about where you are now and where you're looking to set aside the excess money you have to take care of yourself in future, whether that's next week, next month, 2 or 3 years from now when you're going to have a new vehicle, or if you're talking well out in time into your retirement, a commitment to savings is very important. So it's not a matter of saying that you can do TFSA, RSP, or nothing at all. It's figuring out what is the appropriate way to manage your cash flow, to budget in an appropriate way, so that you've got savings to take care of yourself out there in the future. So in particular, when you are setting aside money, when you're thinking of this comparison with TFSA and RSP, what particularly are you saving for? And that's not to say that you have to make that decision or focus your attention every single time that you put money in one place or the other. A lot of this hopefully will be on automatic deposits, so that you don't have to have it coming up in your face constantly. But if you're going to do the comparison of the two, you want to think about, at the stage when you set up the automatic deposit, for example, what are you saving for, and when do you need the money to come back to be used for the purpose that you are saving? And where tax comes into play here is that the tax treatment of TFSA and RSP, as I said, is somewhat mirrored. RSPs, you are investing pre-tax. With the TFSA, you are investing after you have paid taxes. And then there are other features of the two that might cause you to lean one way or the other in terms of which one that you might use. So RSP TFSA is our main comparison here. But again, you can use other places to save your money, whether it's a non-registered investment account, whether it's some type of tax sheltered supporting account like an RESP for education purposes for a child. It could be a registered disability savings plan, which also has tax sheltering aspects to it if there is someone in the family who has a disability. But we're just going to stick to this RSP versus TFSA comparison. So starting then with the RSP, sorry, just moving something out of my way of my screen here. With an RSP, basically what you're doing is you're using your savings right now that you otherwise could consume, and you're pushing it forward to be able to use that in the future. So using your current productive capacity, the earnings that you've taken in, and not consuming, but making sure that you have something to consume out there in the future. And an RSP can either be set up where it's an individual plan that you own distinctively, entirely on your own, or it could be a workplace plan where the employer who you are working for is making contributions into an RSP, which is grouped up in terms of its administration with the other people with whom you work. But otherwise, the ownership of the assets that are inside of that RSP are yours. So the idea with an RSP is that when you are working and earning income, employment income, then you are entitled to then place some of that money into an RSP, which then is not taxed in that current year when you earn it. You are pushing it out into the future to be taxed at a later point in time. And so you get a tax deduction by making use of your RSP. Once you have money in there over the long term, the fairly long term, I don't know what age each person is here, but over the longer term, you're going to accumulate, and then you can take the money out of that during your later years to provide for yourself when you're not earning income anymore. And the draw out of that must occur no later than December 31st of the year that you turn 71. When I say the draw out of that, having already mentioned that when you take money out of an RSP, it's taxable, I don't mean that you have to take it all into taxable income at that point. You could collapse the entire thing and have it all taxed in 1 year, but that's generally going to be a bad idea for most people because we have a graduated tax bracket system where for higher levels of income, we pay higher rates of tax. If you have some decent accumulation in your RSP, then chances are that you're going to have a very large amount that's going to push up into higher and higher tax brackets, perhaps in the highest bracket, and so you'll pay a very high rate of tax on that. So usually what people will do is some combination. Maybe you take some out immediately at that point if you're no longer working that year when that happens, and you'll be taxed on that. But otherwise, you would either transfer that money over into a registered retirement income fund or a RIF. And the other alternative you have is to purchase an annuity, which then an insurance company pays you an annual amount to you after that point. Paul, you wanted to come back on here to make a point to me here. I think I saw just some movement here. Did you want to come in?
Yeah, I did, Doug. Thank you. Sorry to interrupt. Just we came across the realization we're having a bit of a tech challenge in the background. Apparently, the question and answer function for today's presentation was disabled, and we're trying to get that back up and running. So we apologize for that. In the meantime, if you do have a question, please feel free to send it through to us. The email that we're using right now is brand, B-R-A-N-D, brand.support, S-U-P-P-O-R-T, brand.support@libro.ca. We'll try to get that posted so you don't have to remember it, but it's brand.support@libro.ca. If you have any questions, we'll do our best to monitor them and bring them into the presentation with Doug. Apologies for the confusion.
Okay, so that's pretty much all I wanted to say on here. In terms of the comparison, though, of RSP, Registered Retirement Savings Plan, and the RIF, Registered Retirement Income Fund, an RSP has a maximum amount that you're allowed to place into it each year, whereas with the RIF, there is a minimum amount that must come out of it once you have shifted money over into a RIF. And I'll talk a little bit more about the RSP maximum in just a little bit. The RIF side of things, I'm just going to leave aside. We're really just looking at the funding mostly of RSP versus funding money into a TFSA. So in terms of the benefits you get from making use of an RSP, the core benefits that you get is three benefits: time shifting, tax sheltering, and then tax shifting. And what I mean by that, if you look at this visual that I have here, it's without showing the axes here. The left to right axis is the course of time, and I've grouped these things up to say, well, the first couple of dollar signs are a number of years, a decade perhaps for each of these dollar signs, and then at the retirement point, that's the time that you'll spend in your retirement years. So a couple of decades or a few in your working years, and then some time in your retirement years. Maybe you'll have more time in your retirement years than you have in your working years. And then the vertical scale here, the vertical labeling that's not showing is simply dollar amounts. So during your working years, if you don't push money into your RSP, then you're going to go up through tax brackets. And I'm showing this as if there's 3 tax brackets. There's actually, depending on province, it's somewhere around 10 or so. Certainly that's the case in Ontario, that you go up through tax brackets. So with making use of an RSP, what you're doing is you're taking money that otherwise would be taxable to you at your highest marginal tax bracket, and you're pushing it out, you're time shifting it so that you can use it at a later point in time. Once it's in the RRSP, then all of the income happening in the RRSP is tax sheltered, and over the course of time, maybe it goes up and down a little bit in any given short time period, but over the longer period of time, you expect that things are going to grow in value, and so that growth, which otherwise might be subject to tax if it was not in a tax sheltered RRSP, will in fact grow without being depleted during the time while it's in the RRSP. And then when you draw the money out in your retirement years, then, and this is the RIF side of things, the Registered Retirement Income Fund, as you draw down, then what you've done is not only have you time shifted out the point at which you'll be taxed on that money, which otherwise would have been taxed on a current year, but you've also shifted the tax down into lower brackets most often, because in your later years, you are likely to be at a lower tax bracket than you were in your working years. There's not a guarantee associated with that, but that's the general structure that we see more often than not. And so we have pretty much allowed for ourselves to have a lower tax rate applying to the income that we otherwise would have been subject to tax in our working years at a higher tax bracket. So let me turn the corner then and talk about tax-free savings account now that we've got the RRSP, the main components of the RRSP laid out there. So with the TFSA, as compared to an RRSP, where your ability to make use of the RRSP is dependent on you being a worker, having employment income, with the TFSA, it has nothing to do with whether or not you're working. It's simply that if you are over the age of 18 and if you're a Canadian resident, then you're allowed to make use of the tax-free savings account. You get the allocation of contribution room available to you. You're not given money, but you're given a certain amount of room or space that you can make use of. In order to do that, you do need to have a social insurance number in order to place the money into an account, to open one. And other than that, it's really not much more complicated in terms of you being eligible to make use of the TFSA. Contributions, and I'll talk specifically about the contribution room where it stands right now. It started at $5,000 back in 2009. And then there's an indexing formula that applies to the base amount that then on a rounded basis, once the index goes up to a rounded next $500 level, then the TFSA room will bump up to that next level. So whereas RRSP room changes from year to year, with the TFSA, they're rounder numbers. It was originally $5,000, and then it became $5,500, as I say, in a rounded basis, which makes it a little bit easier to keep track of from that perspective. It doesn't change on an every year basis like the RRSP, although as I'll comment in just a moment, it may be that we'll see a second year in a row that the TFSA room could be increasing. So if you don't use the TFSA room in a given year, then you can carry that forward to be used in any future year. As long as you're living, you can make use of the TFSA room. And unlike the RRSP, where you get that tax deduction when you make a contribution to the RRSP, you don't get a deduction with the TFSA. But when I show you the side-by-side of the two of them and where you get your tax features, you'll see that, again, there's a mirroring of how these two programs operate. So the fact that you don't get a deduction does have a quid pro quo on the other side in terms of when you draw the money out. And that's basically that you don't have any limits on when you draw the money out of a TFSA or what you use the money for. Mind you, on the other hand, with an RRSP, you're not required to take it out during your retirement years, but if you take it out at an earlier point in time, then you might put your future at risk at a time when you are no longer earning any income. So you have to be conscious of that with drawing on your RRSP money too early before you get into those later years. So you can take the money out of the TFSA anytime for any purpose. It does recover the contribution room, which I'll talk about a little bit in a second. And the other thing is that when you take the money out, it's not taxable. So Paul, you want to come back on here? You want to update? You want to stop me and update everyone
well,
here?
Just a question from the audience from Gary, and thank you, Gary, for submitting it. And again, if you do have questions, apologies for the technical issues here, but brand.support@libro.ca. So we are getting questions through. The difference between registered versus non-registered account or non-registered plan. Terminology we use all the time, and it's a great reminder that not everyone's always as familiar as maybe we are. And just at the most basic level, what differentiates a registered plan from a non-registered plan?
Right, and there's a variety of quote registered plans, and that term, and I'm not obviously going to quote you off, and I couldn't quote you off exactly what it says in the Income Tax Act, but that term of being registered generally means that in the Income Tax Act there are certain types of plans which have some type of tax preferred status when you are earning income within them, which generally means that there is no tax applying while accumulating in that plan. If you don't make use of any of those plans, if you were to directly own an investment without going into one of the tax sheltered plans, then the earnings would be taxable to you when earned on a year-to-year basis. So the benefit of the registered plans generally is non-taxation as the income is earned, and then depending on the type of plan, and I rifled through a few of them there at the beginning, the TFSA and the RSP that we're talking about, our ESPs for education, our DSPs for disability savings. Those are the main types of registered plans that allow for that tax sheltering. And so the non-registered accounts are those that don't have any tax sheltering capabilities built into them. I don't know if that's the greatest definition that I've given there with it, but gives you a rundown on things. Paul, did you want to come back in before I continue on here?
No, just could you double check that you're sharing your slides, Doug? We're having a bit of a technical issue again here, and apparently your slides have dropped off. So we can see you, but we can't see the slides at the moment. There we go.
Okay.
I can see the slides now on my screen, so that looks good.
Okay. Okay. All right. So now, just you mentioned that did they go off? Was I on this slide when they disappeared? I didn't notice anything change on my screen.
Yeah,
I know
this was the last slide that was up. Correct.
Okay. Okay. So just continuing on then with the TFSA. The last point was that when you take withdrawals, you're non-taxable on those withdrawals. And one of the interesting and distinctive features of the TFSA is that you get a recontribution credit with TFSA. So when you take withdrawals in a given year, then you are allowed to put the exact same amount back into the TFSA. You have to be careful when you're putting money in and out of the tax-free savings account, because effectively what happens is when you put money in, it increases the usage of the available room on a year-to-year basis, which will roll forward. It increases the use of it during the year. But the credit for recontribution, though it's available to you, doesn't happen until the following January the 1st. So you can't use this as an in and out during the course of the year without the risk of potentially exceeding your available TFSA room during the course of the current year. So you have to be careful about that if you're going to be taking large amounts that are going to come out, that you may not be able to put those large amounts back in again immediately. You may very well have to wait until the following January the 1st. That does not include where you use the forms that are available from Libro to do a transfer where you're importing effectively a TFSA that's at another institution. You're bringing it over in its current form as a TFSA. That will not run you into this same risk. It doesn't get treated as an extra contribution in the current year. So as I mentioned, the credit happens on January 1st of the following year, of every year. Contributions in a current year are then credited on January the 1st. And if you don't use it next year, then that credit still remains available. It's continuing room that can be used at any point out there into the future. There's no limit on when you have to make the contribution or the recontribution. Just to be clear, because I'm referring to the credit happening on January the 1st, that does not mean that you have to use it next year. It just continues on to whenever it is that you might want to use it. And it has to do with the dollar amount that is available for you as contribution room and for recontribution in this reference point. It has nothing to do with how many transactions you might undertake that would tally up to the contribution room that you are making use of. So I mentioned I was going to give you the figures, the dollar figures right now. So this is for 2023, for the current year. The calculation of the current figures for RRSP room, and then I'll show you what the TFSA room looks like over on the right-hand side. So the basic calculation for RRSP room is that you're allowed to contribute in a current year, or you get credit for contribution room for RRSPs, 18% of the preceding year's earned income, which for the most part means your employment income. There are some additions to that, like net rental income, that can also allow for RSP contribution. But for most people, it is your employment income. So 18% of the preceding year's income, earned income, up to a limit which indexes from year to year. And for this year, the 2023 limit is $30,780. That figure will index in future as the tax brackets index. It goes up just as the inflation factor or the indexing factor applies to our tax brackets. The room uses the same factor for its indexing. The level at which you will max out your available contribution room for RSP for the current year is based on, again, last year, 18% of last year. So at $171,000, you will have maxed out the contribution room that you're entitled to make use of. And again, just like with the TFSA, you don't have to use all of your RRSP room in the year after you earned it, were credited with it from the previous year. You can use it out into the future. Except that, as I mentioned off the top when I was talking about the RRSPs, you can only make contributions into an RRSP up to December 31st of the year that you turn 71. So unlike the TFSA room, which carries forward indefinitely within your life as long as you're living, with RRSPs, you do have to make use of your RRSP room by that point, the end of the year that you turn 71. If you have a spouse, you may decide, and you can make contribution after you are past that time. If your spouse is under age 71, then you can make contributions into a spousal RSP. So these are all pre-tax figures when we're talking about RSP room. With a tax-free savings account, the annual room that's available currently is $6,500. So we started at $5,000. It went up to $5,500 about 2 or 3 years later. It started in 2009. And then we had the 2015 election. It was bumped up to 10,000 during that election year, but then the indexing formula was put back in that brought it back to the regular every $500. So we had this big bump of 10,000 for that 1 year in 2015, and then we're back onto this formula that's taken it from 5,000 to 55 to 6,000. And then last year, going from 2022 over to 2023, we went up to $6,500. And the way the TFSA room is calculated is the annual allotment, the 6,500 currently, plus if you made withdrawals last year, specifically in 2022, then on January 1st of 2023, you would get the credit for those last year's withdrawals. That's the room that you have available that can carry forward again indefinitely out there in time. If you were a person who was 18 years old in 2009 when the TFSA was introduced, and you haven't made any use of the TFSA, which I can't imagine, although occasionally it does come up that people have not made use of it. But if you haven't made any use of it, then the figure right now that you would have available is $88,000. That's how much room you either have not made use of, and so that full figure is available, or you have made use of some of it, and there is some that's left over if you haven't made use of all of that 88,000 since 2009. Now, I mentioned that with the RRSP room, the figure indexes from year to year, and you'll see in the footnote the previous year's RRSP room for 2022 versus 2023. Again, it changes every single year. TFSA, because of the indexing formula, it takes 2 or 3 years before it rounds up to the next $500 figure, except that as we came towards the end of 2022, the indexed figure, the underlying reference figure, was really close to turning the corner or just going over the rounding to go up to $6,500 anyway. So it was just under $6,250, and then once it went over $6,250, it would then round up to $6,500 rather than being $6,000. So it was really, really close. And then, as everyone knows, we've had a lot of inflation over the course of the last year. It was a very high index factor. It was over 6% coming into 2023. So everything was pushed up fairly high. On the TFSA room particularly, it was pushed up fairly high where it's pretty close to passing through the next rounding, which would take it up to the $7,000 level. If our inflation rate, the indexation factor, is just a little bit over 3% this year, and it's round about that level, it's based on the end of September on a 12-month rolling basis, then we could see the TFSA room move up to $7,000 in 2024. Now, if it doesn't happen, then it will be very close to it. So it'll still be $6,500 next year, and almost not guaranteed, but almost invariably likely that we will have 7,000 when we get out to 2025. So something to keep an eye on, to look out for. Paul, did you want to come back on again?
Yeah, a couple questions, if you don't mind, Doug. One for Shane about, can you open a second TFSA with another bank, or can you only have one? The biased answer from Libro is we'd love to have all of your business here, only have the one TFSA with us. And what are these other financial institutions you talk about? But Doug, the question is, can you have more? And then there's a follow-up question from another individual, but can you have more than one TFSA across multiple institutions?
Yeah, and yeah, you can have lots of TFSAs if you want to do that. It may be that you want to have different ways that you use your TFSA for select purposes. You might have one that you're using, again, as part of your accumulating towards a home. You might have another one which is for another purpose, and for whatever reason you decide you're going to have it in 2 different places, same institution or different institutions. You are welcome to do that, but all of them collectively have to remain within the boundaries of the available contribution room that I'm talking about here.
And the follow-up question is with respect to that contribution room, and it's a good question, and we have had owners run into issues with this in the past. Is the contribution room indicated on either my notice of assessment or the CRA My Account assessment figure something you can trust? If I haven't kept track of my contributions and withdrawals every year, is that notification, at least at December 31, pretty up to date, or can there be problems with that?
So the figure on my account is it's all based on your tax filings on a year-to-year basis. So what happens is all the financial institutions with whom you have a relationship will report into on filing their information with CRA. They'll report into CRA. You'll do the same, and your responsibility to file your tax return. And at one point in time, CRA will know where you're at with the movements of the ins and outs, literally ins and outs on your TFSAs. So they can tell you at that one point in time what is your available room. By the time you find that out, you may very well have moved some money in or out of those accounts. So it could be still challenging to know where you're at. It should be a correct figure based on the filings. If everyone's done what they're supposed to do, it should be a correct figure as of January 1st of the year. But then don't forget, you may very well have been moving things in and out either on a manual basis or automatic withdrawals or automatic contributions that may have happened, and so that's going to affect what that figure is. So just don't act too quickly. You do not want to be in an over contribution position, because the over contribution means that you are taxed at a 1% per month basis on the highest amount that you have over contributed during the course of the month, and it's calculated every single month that you're in an over contribution position. It may very well be that you don't find that out, you don't figure out that you're over contributed until you file your taxes next year, and you may very well have many months of problems that then you have to deal with because of that extra 1% per month penalty tax. So just be careful about that.
Yeah, thanks. And one more argument to have it all at Libro. I'll put that little plug in before I turn it back to you. Thank you.
Yeah. Okay. All right. So I'm just going to move on to the next slide. This, no, look, I'm just making sure as I lost my screen before, whether it was something that I was doing in changing screens, but I'm still seeing the red ribbon. So I'm pretty sure that you're seeing my slides here. Okay. Here's the one place where I said I was going to give you some arithmetic, and I'm not going to make you work for it here. I do want to emphasize this point though. RRSP room is expressed as a pre-tax amount, whereas TFSA room is an after-tax amount. So when you talk about the two, just keep that in mind. You don't have to do the arithmetic, but keep that in mind, that the two places that they are referenced are two different ways of looking at the money. If you wanted to convert your TFSA room into what would otherwise be more RSP contribution, you can't do this. I'm just saying that if you wanted to do a comparison that said, hey, if the government just said, here's some more RSP room, what would the TFSA room look like if you were to do that? So here's a real rough idea. Ignore everything else except the Ontario line here. So on the Ontario line, how much more RSP contribution room would you need as someone who is at each of these income levels, $50,000, $100,000, or $150,000 of income? Because it depends on what your marginal tax bracket is at those levels. What is your highest tax rate that applies to those levels? So I'll just do the 50,000 because it's the easiest one to look at. So in Ontario, for someone who's a $50,000 income level, if you had $8,570 of more RRSP room, then based on your marginal tax rate, if you were taxed on that $8,570, that would bring you back to $6,500 that you could then make a contribution into your TFSA. The reason why I bring this up is I've seen comparisons, not so much anymore, but in the early years of the TFSA, I've seen comparisons where it's done as a side-by-side and said, hey, if you want to make a contribution to a TFSA or RSP, what's the difference between the two? Here's $100 into RSP and $100 in the TFSA. And my response to that is, hang on a second. If you're contributing to the RSP, you're using your pre-tax money to go into it. If you're going to the TFSA, you have to be taxed on that money and then see how much you can put into your TFSA. So this gives you something to use as a comparison of the two, what that might look like if you had TFSA room converted into RSP room. So here, leave aside those numbers. Here's the side-by-side on the two. There are 3 time points that you want to look at: when you put money in, while it's inside, and then when you take the money out. So with the RRSP, you get to take a tax deduction when you put the money in. So you're putting in pre-tax money into the RRSP. While the money's on the inside, the income that you're earning is tax deferred because it's going to grow in value and you're not being imposed with the taxes on a year-to-year basis. But then when you take the money out at whatever time out there in the future, you are taxable on all the dollars that you take into your income in those later years. The tax-free savings account, this is where I say there's the mirroring or the flip side of the two. Tax-free savings account, you're putting in after-tax money. So you're going from that $85, $70 that you otherwise would have had that could have gone into an RSP. You're being taxed on it, and you're putting $6,500 into your TFSA. I'm not suggesting you actually do that, by the way. I think that it's a good idea that you actually use your RSP for your retirement savings in particular as your priority. But that's the difference between the two. Is you've got after-tax money with the TFSA, you get the tax sheltering, and then the withdrawals from the TFSA are tax-free. Now, you'll notice in the middle, I've got a different word that I've used here: tax deferred with the RRSP, because eventually it will be taxed, whereas with the TFSA, it is truly ultimately tax sheltered because the money coming out is tax-free. And the question that does come up is, which one might I make use of, the TFSA or the RRSP, in a given circumstance? And it does come back to that question that I raised at the beginning. What is the purpose of this particular amount of savings, and when do you expect you're going to draw that out? If it is for retirement, then chances are you're going to be at a lower tax rate in your retirement years, and therefore contributing this particular dollar into savings would be better to go into an RSP than the TFSA. But if you do expect to be at a higher tax bracket when you draw this particular amount of money out, then TFSA would be preferred over the RSP. The other thing is, if this is something which is needed on a shorter term basis, again, I'll come back to the housing, if you're saving for a down payment, then putting the money into an RSP is something which is ultimately for retirement savings. And so if you were to imperil that by taking it out before you get to those years, then you're putting yourself in a difficult position. So if you have a shorter term need, something which you actually are looking at right now out there, whether it's 1 to 5 years or a few months, certainly, then TFSA might be a better choice to make for that particular savings. Now, if you're at the same tax bracket going in and coming out, it doesn't matter whether you use the TFSA or the RRSP. So let me give you a real simple version of this to do the comparison side by side with the RRSP and the TFSA. If you're at a 40% tax bracket in this comparison, going in to put the money into the savings and coming out, then with an RSP, you've got $100 that's being invested because the 40% tax rate is irrelevant to you. You're putting pre-tax money into the savings. And then when you draw that money out, and we'll assume this is a little bit further out in time, a few years out, but you're still at a 40% tax bracket rate, then you're going to end up with $66. Well, side by side with that, if you had a TFSA as your alternate choice, and you then took the money into your own hands, you would be taxed on taking that money out in that current year from your otherwise taxable savings. So you'd only have $60 to invest. But in my 10% interest return world here, or 10% return world, you're going to make 10% off $60 and not be taxed on taking that money into your own hands. So you end up with $66 in either case. And then coming back to what I was just showing you about RSP better when you're a lower tax bracket and TFSA better at a higher tax bracket. If you're at a lower tax bracket when you take the money out, so you go down to 30%, then you'd have $77 in your hands in an RRSP in that lower tax bracket. So looking at that beside the TFSA, you're better off to have used an RSP, which for retirement savings is most often the case for most of the population. But if you do go up in a tax rate, then when you take that money out, if you went into the RRSP and you took it out at a time when you were at a 50% tax bracket, you would only have $55 in your hands. You are better to have used the TFSA in that anticipated world where you're going to go up to 50% from 40 than if you anticipated that you were going to be at the same tax bracket or a lower tax bracket. So again, a lot of arithmetic showing you there just to reinforce the point that if you expect to get a lower bracket, RSP is where you're leaning. Higher bracket, then your TFSA would be your starting point for where you would choose between the two. And then just give you some comparison points, or summarize some comparison points. I already said this, in terms of saving for retirement, I would say that the RSP definitely is your first priority. Most people will be at a lower tax bracket in their later non-working years, and so making use of the RSP is going to make very good sense. You can certainly use TFSA as a complement, particularly as you get closer to your retirement years. Then you might, in consultation with your coach, look over how you've accumulated your savings and determine whether the next contribution to your RSP that you may have thought you were going to make might be better to go into the TFSA, or between the two, maybe you split things up as you get closer to those retirement years, again, depending on how much you've accumulated and where you've accumulated that. With the RSP, you don't have the ability to reuse contribution room, but with the TFSA, you do. You get that recontribution credit. You can make use of both programs with a spouse or common law partner. With the RSP, it's built right in. You, as the person who has contribution room, can use your contribution room to contribute into your own RSP or into a spousal RSP. And then with the tax-free savings account, there isn't something called a spousal TFSA, but you can give money or gift money to your spouse, and he or she can place that into their TFSA, and there's no negative tax consequences for having done that. You'll be able to then make use of both of your available TFSA rooms, plural. You can certainly use the TFSA for using for a home purchase or for education without having to be concerned about any additional rules that will apply. RSP can be used for using the money for a down payment or for the later age education, drawing that money out in each case to use for those respective purposes. But with the RSP, you have to then contribute the money back in. You're effectively borrowing from your RSP in doing that. So you have to be careful that you have the ability to contribute that money back in. Otherwise, you'll end up being taxed on those withdrawals that you've taken. And then in terms of using borrowing in conjunction with either of these plans, you can borrow to invest, spousal or not spousal, an RSP loan. You can do that. You can borrow to invest into a TFSA, but in either case, you don't get a deduction on that because you're getting tax sheltered income off of it. Again, conversation with your coach about whether that's appropriate for you. It could be a costly way to get the money into either of those plans. And then the last item here is once you have money in those plans, you can't use that as collateral to borrow against. If you do that, you run the risk that the plan gets deregistered, and then you will have some negative tax consequences associated with that, either with the RSP being taken entirely into income, the amount that is pledged, or with the TFSA that it then becomes taxable, whereas previously it was non-taxable. So both of those provisos should be very much top of mind if anyone ever suggests to you to leverage against your RSP or TFSA. Last thing that I wanted to bring up here, and Paul, I'll let you step back in here to further comment on this. It is a quick comment that I'm going to make here. We have the First Home Savings Account, which is now available as of this year. It's a new program which is specifically directed towards allowing people to accumulate money towards down payment. The FHSA has some components of the TFSA and the RRSP associated with it. So you get deductibility when you contribute money into an FHSA, first home savings account, just like you do with an RRSP. The allotted room is $8,000 per year that you can contribute in to a lifetime maximum of $40,000. So that's the contributions that you are allowed to place into the plan. And then when you take money out, if you're using it for purchasing a new home, like the TFSA, a withdrawal for that purpose is non-taxable. So that's a great deal. Deductible going in, non-taxable coming out, tax sheltering while on the inside that will then allow you to accumulate more. So the deposits and the growth will be able to be used then for the purchase of the home. If you don't use the money in the FHSA for purchasing a home, then the amounts that you take out will be taxable. But there's a really nice concession that if you're otherwise going to take that out and be taxable on it, you can then contribute that over into RRSP, or even if you're at the later ages, into a registered retirement income fund, and you don't burn up any RRSP room in doing that, or you don't require any kind of special room if you're going to have that go over into RIF. So it is something that is probably not a strategy that you would undertake as a conscious decision, that you would accumulate in the FHSA, not use it, and end up having that go over into your RRSP. But it is a nice backdoor opportunity that you have if you are ultimately not going to be using that to buy a home, that you can then end up with that back over in an RRSP. And then just to bring the other two types of ways that you can make use of the RRSP and the TFSA, the RRSP home buyers plan is the one in the middle. The TFSA is the one over there on the right. And as I already went through the nature of the RRSP and the TFSA, you can make use of the home buyers plan out of accumulated money in an RRSP. You do have to though pay that money back into the RRSP beginning the second year after you take the withdrawal for the purpose of the purchase. If you don't pay the money back in, then you're taxable on that. With the TFSA, there is no requirement to pay back in again. So the home buyers plan gives you $35,000 of allowable room that can come out of your RRSP. And with the TFSA, it's whatever you might have accumulated that's available to you to take out and use for home purchase. You can use one, two, or all three of these on a given home purchase. You're not restricted, as was originally going to be the intention, that you either could use the RRSP home buyers plan or you could use the FHSA. So Paul, I'm going to leave this up here for a second. If you wanted to come back in here before I bring back up the agenda slide summarizing all the points, just wanted to give you the opportunity to comment on this, because I know this is something which you keep an eye on.
Yeah, we did have one question come in, and I apologize, I'm not really understanding it, but I think, and I'm paraphrasing here a little bit, the question is, can they have multiple different types of a tax-free savings account, RSP? So for example, could you have a TFSA that holds a GIC, a different TFSA account that holds a mutual fund, a different TFSA that maybe holds cash? The short answer to that is yes, as long as you're within all of your individual contribution limits. And I apologize if I've misunderstood that question. I think that's what they were asking, and that was the only question we had outstanding at the moment.
Okay. Well, I'll just bring this back up as a bit of a prompt to people of the things that I've covered over the course of the time here. If anybody wants to jump in or squeeze in an additional comment or question, and otherwise I'm going to turn it back to you, Paul, because I'm wrapped up with what I had as prepared material here.
No, and I appreciate that, Doug, and thank you for the great amount of information. We genuinely appreciate that. And again, I want to apologize to our audience for some of the technical issues we experienced with the Q&A session. So thank you to those that were able to send their questions in. I've been working with advisors and investors directly for well over 20 years now in my career, and I've learned a couple of things. Is that we focus a lot of attention on the rate of return. What's your best GIC rate? What mutual fund is going to get me the best return for the next 5 years? Nobody knows. That's a crystal ball question that nobody has the answer to. If I could tell you that, I'd have a different job. But the idea here is we don't pay enough attention to the rest of it. We don't pay attention to the impact of inflation and taxes and what's the back end goal for this money. Savings is a behavior. Creating wealth is a behavior, and it's driven by your behavior and your discipline as an investor. And the thing about savings is you don't even really have to have a great reason to get started. You just need to get started. We can help. We have coaches here at Libro that can certainly help you with the when to save it, where to put it, what type of account to use, what are the tax implications of that going to be in the future. And whether you're just getting started or you have a really complex investment portfolio with significant tax implications, we've got coaches here who can help with great expertise, to bring in experts like Doug, to bring in our internal experts as well to help with that. So Doug, again, thank you for the presentation today. There's a lot of information. There will be some follow-up coming after the meeting. If you have a real specific question specific to your situation today and you have a coach at Libro, please reach out to them. If you don't have a coach at Libro, we'd be delighted to help you find one. Thank you, everybody, for your time and your attention today. And we look forward to doing future presentations coming soon. Thank you.